In that, first of all, I'm dictating a note to you. I request you to write down answer along with me. First point, debtors slash accounts receivable turnover ratio is indicating number of times debtors are rotated in a year. Second point, debtors turnover ratio is useful to compute average collection period. Third, in this question, directly or indirectly, information is not given about fixed cost. Full stop. So it will be ignored in calculation of answer. Full stop. Neither it will be considered in carrying cost, comma, nor it will be considered in profit or loss calculation. Fourth point, carrying cost will be calculated only on variable cost. Full stop. Now we are writing answer with the method number 1, that is the total profit or loss approach. Why only first method, not the second method, sir? No reason for that. Comparatively, it is like the first method seems to be simple, That is the reasons I am going with the first method. Let us answer along with me. Step number 1. Calculation of total fixed cost. In that, write down no information is given about total fixed cost. So it is ignored in calculation. Step number 2. Calculation of variable cost to sales ratio. In that, write down 70%. Again, it has been given to us directly in the question. Step number 3. Calculation of total profit or loss. In that, working note number 1. Calculation of average collection period. In that, $12 divided by debtors turnover ratio. We have been provided with the debtors turnover ratio 4 times and 2.4 times. So in this, write down 12 months divided by 4 times, that comes to 3 months. Again, on this side it is 12 months divided by 2.4 times. So answer would be 5 months. That is the way the average collection period will be calculated. Next, calculation of the profit or loss for each credit period. There are two credit periods that we have under evaluation. One is 3 months and another is 5 months. And we are supposed to calculate the profit or loss in each of them. So average collection period in terms of number of months, it is 3 and it is 5. I want you to make the calculation and write your answer in the chat box that what would be the profit or loss in case of 3 months. Don't do for 5 months, only do for the 3 months and put your answer in the chat box. Dear students, the sales is provided to us as 30 lakhs right now. I request all of you to write down answer along with me. Sales is an amount of rupees, say 30 lakhs. Variable cost is 70% of the revenue. So it is 30 lakhs into 0.70. That comes to 21 lakhs. Fixed cost information is not there, so we are ignoring it. Carrying cost, in that it is like the variable cost divided by 12 months into average collection period into cost of capital. So variable cost is 21 lakhs divided by 12 months into right now collection period is 3 months and cost of capital is provided to us as 20%. So over here we understand it is 21 lakhs into 3 into 0.2 divided by 12. It is 1,05,000. Next is the bad debts. Loss on account of bad debts is 3% of the revenue. 3% of 30 lakhs comes to 90,000. Deducting all these expenses from the revenue will get the profit or loss. So it is 30 lakhs minus 21 lakhs minus 1,05,000 minus 90,000. That comes to 7,05,000. This is the way we compute the profit or loss right now. Now let us have discussion for the 5 months. In case of 5 months, the sales value is given as 45 lakhs. So over here, this is an amount of 45 lakhs. Again, the variable cost is 70% of the revenue. So we understand it is 45 lakhs into 0.7. That comes to 31,50,000. Next is the carrying cost, 31,50,000 divided by 12 months. Multiplying with the collection period, which is 5 months, into 0.20. So 31,50,000 into 5 into 0.2 divided by 12. That comes to 262,500. Next is the loss on account of bad debts, which is provided as 6%. So it is 45 lakhs into 6%. That comes to 2,70,000. So till this point of time, everything is the same as what we already have calculated with no differences. Now again I am explaining the new point to you. Dear students, the question is providing the information that with the new policy, first stock will increase and second the creditors will increase. Like that information is given. We know friends that as far as the stock is concerned, stock is like an item of the current assets, and we know that the creditors is like a current liabilities item which increases by 50,000. So in short, what will happen? We understand that say with the implementation of the new policy, there is an increase in the stock and increase in the creditors. So there is an increase in the working capital by 1,50,000. How this is 1,50,000? We understand that it is 2 lakhs minus 50,000. So there is an increase in the working capital by 1,50,000. Now logically we understand that, say, whenever there is an increase in the asset in the business, okay, there is an increase in the working capital, means there is an increase in the assets in the business. This amount of the additional investment is required to be financed from some source of the finance. This amount of the additional funds is required to be financed with some source of the funds from where it is supposed to be financed. We understand that over here, so from the given information, this 1,50,000 is the additional investment that we have to make in the business, and this 1,50,000 rupees of the additional investment will have the opportunity cost at the rate of 20%. Means this amount of the investment of 1,50,000 could have been made somewhere else, and we could have generated some amount of the return. So whatever the opportunity cost that we have for investing the funds somewhere else, that is supposed to be recovered from this new business. That is supposed to be recovered from this, like the new policy which we are implementing. So we will mention something like this. Carrying cost of working capital. In bracket I am writing stock net of creditors. So in that case it is 2 lakhs minus 50,000. So 1,50,000 into 20%. That comes to an amount of 30,000. So we understand that, say, from the like a revenue, all the expenses will be deducted, say, to compute the profit or loss. We have to make a comparison of the existing profit with the new profit. And if at all the new profit is more than the existing profit, the new policy will be implemented, not otherwise. That is what we understand. So it is net profit or loss. In that case it is 30 lakhs minus 21 lakhs minus 1,05,000 minus 90,000. 7,05,000. In case of the proposed 45 lakhs, 31,50,000, 262,500, 2,70,000, 30,000. So 787,500. Dear students, I am just repeating this point again. The incremental working capital carrying cost. Dear students, we understand that, say, if at all we implement the new policy, then it has been given that, say, there will be an increase in the stock by 2 lakhs. There will be an increase in the creditors by 50,000. Means we have been provided with the information that, say, indirectly, that there is an increase in the working capital by 1,50,000. Like that information is given. Now, whatever the amount by which, say, there is an increase in the assets in the business, that is required to be financed, say, from some source of the finance. So we understand that, say, with the implementation of the new policy, there is an increase in the investment in the business by an amount of 1,50,000. This additional investment of 1,50,000 is required to be financed, say, from some source of the finance. And whatever this additional investment that we make in the business, that could have been invested somewhere else. And whatever the rate at which we could have earned somewhere else is the minimum return which we are expecting from the business. So this 1,50,000 into 20% is the carrying cost of the additional working capital. And we want to make sure that the new credit policy is able to generate sufficient revenue to cover up this additional carrying cost. That is an amount of 30,000. Accordingly, we make the calculation of the profit or loss with the new policy. Please write an answer. So write down final answer, decision. The company should implement new credit policy. Full stop. Further write down, for the purpose of decision making, we have to take into account carrying cost of additional working capital, comma, to be recovered from new credit policy. Full stop. Importantly, additional investment has an opportunity cost and it is to be recovered from new credit policy. Full stop. So let us have a small summary. In step number 1, we are calculating the total fixed cost. However, in this question, it is not given, so we are ignoring it. In step number 2, variable cost to sales ratio, it is given to us as an example 70%. In third step, it is profit or loss. Over here in this question, there is a new working note, that is calculation of average collection period. Then profit or loss for each of the credit period, that is 3 months and 5 months. For 3 months and for 5 months, sales, variable cost, carrying cost, bad debts, and very importantly, carrying cost of the additional working capital. Means whatever the additional investment that we are making, so that amount could have been invested somewhere else, and the amount of 30,000 rupees is required to be recovered from the new credit policy. And importantly, remember that once we increase the credit period from like 3 months to 5 months, then in that case, this additional investment of 1,50,000 is required to be made not only for 5 months. It is required to be made till the time this new credit policy is going to remain implemented. So we have calculated annualized carrying cost on the same 30,000 rupees.